Finally, a possible deal. 41 days into the longest shutdown, consumers are losing confidence, companies are shouldering tariffs, and traders are chasing headlines. Investors do the opposite, focus on earnings, jobs, and inflation, not the noise. A shaky labor tape, sticky services inflation, and a possible CPI release this week mean discipline and patience. They will pay off. And here we are at day 41 of the longest U.S. government shutdown in history. I said on Friday that investors were showing signs of stress, and the weekend didn't exactly hand out calming tea. The Fed looks as mixed up as a GPS in a tunnel. Valuations are high, and the labor situation is wobbly enough to make even the optimists check their seatbelts. Some valuations may be defensible, depending on how you pencil the future, but let's not pretend the pencil hasn't been shaking. Last week's private surveys gave us a decent snapshot of corporate mood. ISM's manufacturing and services PMIs, my go-to corporate sentiment gauges, came in negative to neutral. The services PMI held above 50, so technically expansion, but the guts of the report pointed to sticky inflation and labor softness on both sides of the economy. And the anecdotes, those little truth nuggets buried in the margins, well, they grew louder about tariff pressures making its way into pricing and planning. When operators start mentioning tariffs unsolicited, you better listen. Consumers are hearing the noise too. The University of Michigan Sentiment Index printed just a hair above its worst level since the series began in the late 70s. Surveys are always a little tribal, which is why I split them by party. But this time, every camp slid lower. Republicans, independents, Democrats, all down. That's rare. Even rarer, Republicans softer when their party holds the White House. The shutdown isn't just a beltway story. It's a kitchen table headache. Remember, Friday's reading was the preliminary cut. The cleaned up final will arrive later this month, but there was plenty of there. Spontaneous shutdown mentions quadrupled, which is survey speak for people brought it up without being asked. And markets may shrug at DC drama, but voters don't. Some respondents even blamed the shutdown for recent job losses, which may be partly emotional, but sentiment becomes spending when it sits in a wallet long enough. There was a brighter patch though, sort of. The top tercile of stock owners saw an 11% lift in mood. In plain English, the wealth effect is doing what the wealth effect really does. Wall Street and Main Street aren't walking the same sidewalk, and the gap really matters. If you own a lot of stocks, your life feels different than if you own a lot of bills. Zoom in on jobs. ADP counted a but positive 42K private sector hires after 2 straight negative months of losses. Trend, not one-offs, is the watchword, and the trend still looks pretty unhealthy compared to last year's 233K October pop. If you want more color, dust off the never cited, except during shutdowns, Challenger Gray report, which flagged the biggest October cuts in 2 decades. 153,000 announced layoffs, up roughly 175% year over year. That doesn't sink the economy by itself, but it absolutely hits certain tickers, certain sectors, and definitely hits psychology. And now for the finally some good news file. While your teams were losing games and you missed the Brazil Grand Prix thanks to a streaming spat, the Senate actually moved. Late Sunday, 8 Democrats crossed over to advance a bill to reopen the government, restore back pay, and temporarily block additional federal filings through January 31st. There's also a promise for a December vote on healthcare subsidies, which is where the next fight really lives. Call it a truce. Not at all a peace treaty. Funding for now with a political boomerang inbound, trust me. Futures cheered, but the ink is hardly dry. The House still needs to come back, vote, and swallow the healthcare wrinkle that shifts dollars toward consumers' accounts instead of insurers. That's going to stir some hornets. So yes, we have movement, not resolution. After 41 days, motion counts as progress, but let's not confuse a green light with an open road. Meanwhile, earnings quietly did their job. Results last week were generally good, with EPS growth outpacing both my expectations and the streets. That is a known positive. The question is whether it can keep absorbing the macro grit, tariffs, wages, and the psychology tax of a long shutdown. Companies continue to adapt. They trim costs, realign capex, and find margin where they can. American enterprise remains a beautifully stubborn thing, my friends. Now, about this week. If the shutdown thaws fast enough, we just might get CPI, PPI, and retail sales back on the calendar. Last month's delayed CPI had energy and some core goods nudging year over year to 3%, which is like catnip for Fed hawks who want to spot tariffs pass through in real time. Combine that with squishy soft data and ugly unemployment numbers, and you have a market that is desperate for hard numbers. A hotter than expected CPI would rattle cut hopes. A cooler print would slide us back toward maybe a December ease. Either way, data will certainly move the tape. So ask yourself, does any of this change the macro trajectory? Not yet. The shutdown ending doesn't magic erase the damage. Missed paychecks, delayed contracts, postponed projects, these ripple for weeks. People are tired of hanging in there. They've been hanging in there through sticky services inflation, choppy wage gains, and a perpetual policy soap opera. Washington dysfunction is just the latest variable in the formula already stuffed to the margins. Meanwhile, traders will do what traders do, chase headlines. Investors must do what investors must do, measure, prioritize, and wait for edge. Half solutions create a calm surface with a current underneath. Healthcare subsidies return to center stage in December. Tariffs keep dripping into earnings calls. The Fed is stuck between the rock of inflation and the hard place of employment, with a data pipeline that's been flickering like a bad fluorescent light. So where are we exactly? In the boring middle between cautious hope and chronic deja vu. The labor market is losing altitude without panic. Services inflation is stubborn and rate cut odds are bouncing around like a ping pong ball. The yield curve's warning is old news, but its message about slower growth, it still lingers. This week's CPI, if it arrives, will tell us if tariffs are starting to leak into core goods or if relief is finally arriving. Here's the investor playbook. Focus on what you can measure: earnings, margin, cash flow, productivity, employment trends, and the direction of inflation, not the next procedural vote. Markets may trade the politics, but they price fundamentals. Tech and select discretionaries still have tailwinds from AI-driven capex and post-pandemic transitions. Manufacturing, housing, and small-cap industrials are flashing yellow. Stock picking matters. Time horizon matters even more. And let me land this where I always do. Patience is not passivity. Patience means disciplined focus. It means you don't sell your strategy to buy someone else's anxiety. We've been partly blind for 6 weeks, waiting for Washington to turn the lights back on. We'll get the data, we'll update the models, and we'll keep walking inch by inch. The economy is still moving forward. I have to remind you, the real test is whether policymakers, investors, and consumers can do the same thing without tripping over their own shadows. So, your truth bomb for today is this: politics can jiggle the chart, but earnings, jobs, and inflation draw the trend line. Stay patient, stay measured, and let the data do the talking. Join me every day for Wall Street Truth Bombs, where I drop them here before the market figures them out.